everyone, and a very good evening. You're watching The Money Show on ET. Now, this is your daily dose of personal finance news, views and opinions. It's a show dedicated to you. We answer your questions and queries as well, and of course get you a gist of how you can spend your money wisely as well. Let's tell you what we have lined up on the show today. We'll be continuing the dissection and the understanding of all the news and announcements that came in from the Union Budget 2021. One of them was with respect to the taxing of provident fund investments and ULIPs, especially those who are contributing a large amount of their money in these two schemes. With now that happening, where can high salaried earners invest their retirement corpus? That's what we'll be discussing today on the show with a very special guest. We'll also be talking about then the spike in yields and how it can impact debt funds. We'll be joined by Abhishek Bhasin of Kotak Mahindra to talk about that. And finally, in our Spend with TMS segment, Akhil Gupta of No Broker to talk about the budget announcements in realty. But before we do any of that, here's a quick look at the big headlines at this hour. It's a historic day on Dalal Street. Sensex ends above 50,000 for the first time ever. Robust FII buying coupled with strong earnings propel the markets to fresh highs. The Nifty 2 ends near 14,800. IndusInd Bank is the story of the day. It soared 10% following an impressive third quarter. MD and CEO Sumant Katpalia tells ET now that while there may be minor slippages in Q4, the overall corporate book is very healthy. Airtel jumps back in the black QOQ with the highest ever revenue growth in the third quarter. Mobile ARPUs rose to 166 from 135 compared to the corresponding quarter. Its stock as well hit a record high ahead of these numbers. RIL edges higher in trade after Future Retail moves Delhi High Court against the order halting the 25,000 crore rupee deal. The Kishore Biani-led group claims it will be pushed into insolvency if the deal fails. Hearing slated for tomorrow. And Jeff Bezos will step down as the CEO of Amazon and become executive chairman after a 28-year dream run. Amazon's cloud computing boss Andy Jassy will be the next CEO. Bezos' reign comes to an end even as Amazon posts a $100 billion quarterly sale for the first time ever. Indian government sends notices to Twitter for not complying with its order to remove accounts trying to incite the situation amid the farmer protests. International pop star Rihanna's tweet spurs global support for protesting Indian farmers. Activists, politicians, Human Rights Watch, celebrities extended support through farmers' movement. The government terms comments as inaccurate and irresponsible. The hues of the tricolour are flying high quite literally as India's premier defence and aerospace show, the Aero India, kicks off in Bengaluru. Make in India and Atmanirbhar Bharat sentiment is resonating in the air as the centre formally signs the biggest Make in India defence contract with state-run aerospace giant HAL. Okay, well, those are the big headlines at this hour. Now let's welcome on the show Ashish Shankar, the Deputy MD of Motilal Oswal Private Wealth Management. Ashish, thank you so much for joining us today on ET. Now, you know, the entire idea behind this conversation really is to solve this dilemma of sorts that the FM has put forward, especially for those individuals who are in the high salary category. These are usually the people who the Provident Fund, ULIPs, etc., give a good tax umbrella. It's a great tool really to manage your taxes. A Provident Fund comes in the exempt category. ULIPs as well give you tax exemption and deductions. Now, of course, the FM has capped the amount of exemption you may get. So if you put more than 2.5 lakh rupees into your Provident Fund in a year, the interest on that excess amount is going to be taxable. But the question is over here, Ashish, that we enjoy 8.5% interest on Provident Fund. At least that was the rate of return notified last year. It may be lower going forward given the fact that the interest rate environment is not that great. Would you read into this change in tax as a bit of a big bummer? Do you think that net of taxes, the return may be quite low for some of these people?
Yeah, Mubina, first of all, pleasure to be on your show. I hope I can add value to your viewers. So coming to EPF, see, look at it this way. 8.5% tax-free return is a fantastic return today, any which way you look at it, because, rates on fixed deposits have dropped and many people cannot stomach the volatility of equities. So in a sense, this was a government subsidy given to salaried employees, right? So what the government is essentially doing by reducing it to 2.5 lakhs, so they are saying that, we'll still continue to subsidize returns for the low income earners, but people who have high incomes, right? They should be going out there and buying market linked products, and we will not be offering that subsidy any longer. So that's what they have done. That's the way to look at it. Now, why didn't they completely do away with it? Because at the end of the day, EPF and a lot of these small savings schemes are also a big source of receipts for the government. And they do borrow apart from, the government securities market. They do borrow through these schemes as well. So it's a subsidy that all of us were enjoying for a very long time, which has gone away. And that's how one should look at it. But obviously, like you said, it puts additional responsibility on advisors, and it puts pressure on investors to try and understand some of the market options, and then accordingly plan for their retirement or any other goals that they have. And similarly for ULIP, now that the amount has been capped at 2.5 lakhs, it just brings ULIPs at par with mutual funds. See, mutual funds have always been subject to tax. Depending on the scheme you invest in, the time horizon is different, but it's subject to capital gains and marginal tax. And ULIP was enjoying a tax holiday so far. So that anomaly has been done away.
Yeah, understandably, what the FM's point of view as well is over here. What do you think of the national pension scheme? It's relatively newer. It's just about, I think, 8 to 10 years ago, if I'm not mistaken, that it was introduced. And I have a report over here that says on an annualized basis, it has given, 7, 8, 9% returns. If we have to look at it as an average on all the categories, alternative assets, gilt funds, gilt securities, debt securities, that's essentially the categories that, the NPS offers investors to pick and choose from. Do you think that that's, a good alternative? Because again, it gives you that tax umbrella. You have to pay tax only at retirement.
Yes. So, see, in a sense, NPS is also a market-linked product. What happens in NPS is that to an extent you get tax exemption whilst you invest. Some part of the tax exemption gets subsumed in ATC up to 1.5 lakhs. There is an additional 50,000 which is given. So my view is that, till the extent of ATC or the additional exemption given of ATC CD, one should definitely look at the NPS. But at the end of the day, remember that NPS is also a market-linked product managed by about 6 asset managers. So you can choose your asset manager. So there are two kinds of products in NPS. One is an auto product, which basically designs the asset allocation given your age. So for example, if you're less than 35 years of age, the allocation is more aggressive, where 75% goes to equity type of schemes. And as you progress, in your age, it goes to the moderate profile, and then it goes to conservative, where the equity portion reduces to below 25. So that's the auto option. Second, it gives you the option to do it yourself. That is the active option, right? So either which ways, Mubina, I think once you've done the tax exemption between ATC and ATC CD, you have to look at other instruments like mutual funds. So consider NPS like a mutual fund, But the advantage of NPS is, you have an auto option where you don't have to think how to balance your portfolio depending on your age. So that's the big benefit there. Second, costs are much cheaper. And third, there is also an employer contribution which kicks in there. But even if you're doing NPS and choosing that as your longer term retirement vehicle, you definitely have to spend time to understand the underlying products, the underlying asset classes, and then choose the manager which you like. So, whilst you quoted average returns, the return of an individual from an NPS can be very different depending on either the choice of underlying option, or if you give the auto option, then depending on your age, the allocation will differ. So if you're below 35, it will be 75% equities. So the volatility will be much higher and the returns will be very, very different. So I think it's important to look at NPS as an option for saving for goals or for retirement. But at the end of the day, one also has to spend time understanding these options.
Yeah, that's absolutely true. So, I mean, I would be making an assumption over here, but I guess it would be a fair one if I say that most of these individuals who have a high amount of salary, and that essentially means that more corpus is well to park, they would probably be maybe above 50. So they have maybe 10 odd years left to their retirement. So based on all these developments, how do you think that they should spread their retirement corpus across different asset classes, given the fact that they'll probably be having 10, 12 odd years to retirement?
Right. So there are two things which are important here, Mubina. One is, obviously, how many years do you have to retirement? That is, how many years will your cash flows continue? Second thing is, what is the absolute corpus that you've collected, and what is the retirement expenses per month? Now, either one can do it oneself, on an Excel sheet, or you can do basic maths, or you can go through an advisor. Now, in terms of allocation, right, the thumb rule is that as you near retirement and your cash flows start, there is a cutoff date after which you retire, and you no longer get regular cash flows. You should start getting more conservative on your corpus. So broadly, to keep it very simple for your viewers, there are three basic allocations. The thumb rule. One is the 30-70, where you have 30 debt and 70 equity. The second is 50-50, 50 equity, 50 debt. The third is 70 debt, 30 equity. Now, generally, I believe that in your early years of your career, you should choose the 70 equity, 30 debt option. So between the age of, let's say, 22 to 35, right, you could choose the 70-30 kind of an option. Between 35 and, let's say, 55, you could choose the 50-50. And as you are closer to your retirement age, you should become 70-80 debt and 20-20 equity. Now, 90% of your outcome, how much corpus you will have, and what kind of goals you will have, will get determined by how you allocate your money between these two fundamental asset classes. I'm assuming you've done your insurance and you've kept your emergency funds aside in a bank or in a cash fund, right? I'm only talking about the investment corpus. So as you go into retirement, I think the 70-75% debt allocation, 20 to 25, 30% equity allocation is a good allocation to have. And then after you've retired, you can then plan the withdrawals from that corpus. Now, the investment can happen some across NPS. Definitely the 2.5 lakh full limit you should utilize in EPF. And then after that, I believe mutual funds offer you a fantastic platform to plan your portfolios, to meet the retirement corpus, as well as then to withdraw. They have something called an SWP, systematic withdrawal option, and it becomes very tax efficient because by then most of your funds are eligible for long-term capital gains.
Okay. All right. Well, we'll take this conversation forward. And in the meantime, of course, I'll ask all our viewers as well, if you have any questions on the topics that we've discussed so far with Ashish, you can just send them in to us on the Money Show at etnow.tv. For now, we'll take a very short break and be right back.